Welcome to Idea to IPO. Hello, and my name is Jennifer Stowell. Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. And at this stage, we have over 100,000 members among all of our meetup groups all around the world. We have organized, promoted, and produced over 2,544 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at idea2ipo.com. Our featured speaker today is Jason Putnam Gordon, one of the top venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Jason Putnam Gordon. Jason, take it away.
Wonderful. Thank you very much, Jennifer. It's a pleasure to be here as always. I've been doing this with Idea to IPO since I think 2013, which is fairly early on, and it used to be in person, but now we are coming to you live or recorded across the internet. So this is pretty exciting. Thank you everyone for attending tonight. We've got a great topic that is how to raise seed funding for your startup. And before we jump into it, I want to go over just some background and some information. So not only am I presenting today, but I'm also running all the tech in the background. So if you have a question, that's wonderful. Please use the Q&A function. It makes it easier for me to track. The chat is a little bit harder to monitor. So again, if you've got a question, I love it. I'm going to try and answer them as we move through the material. So use the Q&A function. Now, with that in mind, I'll speak for about an hour. We'll take some questions throughout it. If we're kind of getting hung up, we might defer the questions to the end because we'll have about a half an hour at the end of this program to answer any questions that you've got. Additionally, as you may see in the background, we've got an audience poll. So that's just to get a sense for who's in this virtual room with me. And I'd love it if you filled it out so I can kind of tailor and tweak our conversation today to meet your needs. So with that in mind, I think as you may already know, we are recording. So anything you ask or say or do is going to be recorded for posterity. That is if you submit a question or I read out your question more accurately. So please don't give us any confidential information at this point. With that in mind, I think we should dive right in, if you will. Again, please fill out the audience poll. In a minute or two, we're gonna go through it. I'll let you know the survey results. Super. So I wouldn't be a halfway decent lawyer if I didn't start out our conversation today with some caveats. So today's discussion is general information. It's not designed to be specific advice for your circumstances. We're going to discuss the rules. We'll discuss exceptions to the rules. We'll talk about different fact patterns and what might be applicable to your company. But even if we have even if you submit some questions, or even later if we have a conversation offline or via some email, text correspondence back and forth, at this point, I'm not going to know enough about your specific situation to give you legal advice. So please don't take it that way. Think about this as information to understand the startup background and the way that startups are financed. So with that in mind, let me start by giving you a little bit of my well, I'll tell you what the overview is. So first we'll go over my background. We'll go over your background. We'll talk about structural considerations for startups. We'll talk about what you should consider when you're considering investors. We'll talk about various financing options, right? Today, we're really focused on convertible notes and safes. And then we'll talk about some really important stuff that relates to convertible notes and safes and other raises. And that is the concept of dilution, how you map that out, how you plan for it, how you handle it, so you make good decisions for your company. So let's talk about who should be watching this today. So if you are in a startup and you intend it to be a venture-backed company, this is probably a great fit. If you are already in one, and you haven't raised any capital yet, great fit because you'll learn sort of the roadmap or path. If you're considering it, also a good fit. And if you've previously been in a startup and you're doing this again, one thing that I will always say is that running a business and developing a startup and building a growth company is an amalgam of many skills. So the more you do it, the better you'll get at it. That is because it's a skill, you got to acquire knowledge, and then you got to apply it and you got to learn from it. So welcome back, and hopefully you'll have some good takeaways for today. Okay, so who am I? So I'm a venture capital and emerging growth company attorney. What does that mean? That means I work with startups as they form, as they do their financings, as they exit. And then I also serve as their outside general counsel, sort of playing air traffic controller, handling those issues that are in my wheelhouse and helping direct and take care of the legal needs for things that are outside of my wheelhouse, of which there are a lot as the company grows. I'm with Pellicinelli LLP. I'm in San Francisco, California. Our firm has over 900 attorneys, roughly 25 offices throughout the US. So we're a big shop. But I love working with companies in San Francisco, throughout the rest of the US. And then I work with a lot of international companies as they come to the United States, what I call inbound work. And that's a lot of fun and pretty exciting too. I think one thing that I really connect with my clients is that I have a little bit of the entrepreneurial bug. And before I was at this large firm, I actually started my own firm and ran that for about 6 years or so. So that's kind of how I started to satisfy that itch. And that's something that we share with my clients. I mean, I understand what it's like to start with literally nothing and then build a company from scratch. All right, so let's check out our poll, understand who else is in the room with me. So I'm going to end the polling results. We got a great turnout. 83% of the folks who are in the room finalize their polls. So we've got about 50% of the room are first-time entrepreneurs. Awesome, congratulations, welcome. We've got about 15% are serial entrepreneurs. We've got a couple of angels. We've got some venture investors. So those could be folks that are in venture firms. They could be at a corporate venture arm. We don't have any media folks today. I'm going to share these results real quick. 13% are at a startup or growth company. So when I think about growth company, as we talk about growth companies today, it's kind of outside of the early startup stage. They've already got a product, they've already got some customers, and now they're building and growing and scaling. And actually, I've got a great graph that's going to come up, and we'll talk about that in a second. And then we got some folks at large companies. So good mix, one person from academia, and we got a student. Now, interestingly, at least interesting to me, we've got about 30% of the people in the Bay Area, another 3% from elsewhere in California. So usually when I do these, we have maybe closer to 40% in the Bay Area. So I'm very excited to have people from outside the Bay Area. Venture is spreading all throughout the US and the rest of the world, and it is a super exciting time to be here and work in this space. We've got some other folks from elsewhere in North America, some folks from South America joining us, in Europe and in Asia, and then even some from Africa and Australia. So pretty exciting, a great blend, a lot of people actually in the room, which is a great turnout. And let's dive into the material. Okay, so a moment ago, I just referenced having a little diagram that I think is pretty helpful. And what I like to always do as we start these, because we usually have 40 to 50% of the people in the room as the first-time entrepreneur, is just try and give you some context and give you some context to give you a sense of how these companies grow and develop. So first and foremost, in working with startups, especially here in the United States, especially here in the Bay Area, we almost always see those companies form as Delaware C Corps. There are a couple driving reasons for that. Usually when you're trying to figure out what the right entity structure is, you think about a few things. You think about liability issues that the founders would face. Think about taxes, which nobody really likes to pay. You think about the management structure. You think about what your capital raising requirements are going to be. You think about granting equity to employees and contractors. And then you should also plan ahead and think about your exit. So in line with that, what we typically see is that, and by typically, I mean the overwhelmingly common, is a Delaware C Corp. A C Corp, because if you're going to be raising venture capital, the venture capitalists will require that you have a C Corp because they've got a pass-through entity. And so if you've got a pass-through entity that is, the entity is ignored for tax purposes and the owners are the ones who are taxed, then they'd have to pass those taxes on to their LPs, that is the investors in their fund, and it would be an accounting nightmare. So that's why we end up with C Corp. For Delaware, it's usually because a few things. Also, usually it's the VCs that drive that. Delaware has a very sophisticated corporate law. It's got a great court, which is just dedicated to business issues. That's the Delaware Chancery. So the sort of thought process behind that is that most, if not, most of the legal issues and disputes that are going to come up with regard to the corporate structure and running of the business, those issues are already going to be heard or decided in Delaware. Give you a little bit of better sense for everybody's rights, and it'll help avoid some disputes. Additionally, if you can't avoid that, because the Chancery is in large measure dedicated to business disputes, you've got a sophisticated bench, judges who know what they're doing. They have developed case law. And then the other thing that's kind of interesting is the Delaware Secretary of State's office is just great to work with. They turn paperwork fast. And you may think, well, why would some pedantic thing like that matter? And the issue is, if you are trying to raise financing, or excuse me, when you raise financing, there are certain kinds of financings, or when you're doing certain kinds of restructurings or exits, you're going to have to file paperwork with Delaware, and it can be very time sensitive. So you can have like a super narrow window that you're going to have to get something on file. And you want to be able to get that paperwork processed quickly without some sort of bureaucrat keeping it for game process without good and due reasons. So that's why Delaware C Corp. And then let's talk about the funding structure. I'm just going to kind of move my slides on my screen over a little bit so that I can keep looking at you in the camera, but also make sure that I am giving you good content here. So we've got a little graph here. We've got sort of revenue of the company on the y-axis, and we got time on the x-axis. And you can see there are some blue lines in here, and those blue lines are different stages of the company. So initially, when you start out, you've got, time is at 0 and you've got 0 revenue. And in fact, actually your revenue in one sense becomes negative because you've got a lot of spend because you got to grow and build out a prototype and hire the initial team. And that's in the seed funding stage, which is where we're going to be spending our time here today. And you can see, that happens until what's called the first round of funding, or very frequently called a Series A round, although we can talk a little bit about the branding of Series A versus Series seed price rounds later today if you have any questions about it. And then later, there will be additional cash injections or capital injections that are going to be necessary to grow and scale that company, to kind of really ramp up that revenue, get that sort of hockey stick look until it matures. And that's when the revenue curve starts to flatten out. And then either you will have gotten, if you are successful, either you will have gotten acquired along the way, or you will do an IPO or some sort of other exit. So that's some background. Let's move on to the next slide so that we can talk about considerations when pitching investors. So just quick recap. We're talking about the seed stage where you're putting together the initial prototype and the initial team. And this is sort of the initial seed capital. That is the capital that gets you started, just kind of like a seed gets a plant started when you put it in the ground, if you take care of it and water it and provide it with nutrients to grow your company. Now, when pitching with investors, there are a few things that you need to keep in mind. You're going to need to comply with the securities laws. Now, here in the US, the securities law structures are set up into, okay, what are the securities laws? Securities laws are a set of laws that are designed to protect the investing public. They apply to any company that is selling, or anyone who is selling securities. And so you need to comply with them. And that either means typically registering, which can be prohibitively expensive to do, or finding an exemption, which may require that you still file a notice or something along those lines with either the federal with the SEC, the Securities Exchange Commission, or various state entities that regulate each of these on a state-by-state basis. And it's not just the US, I do work with a lot of international companies. It's not just the US companies that have securities laws. There are securities laws in other states too. So let me give you some examples of what securities are. Stock, safes, convertible notes, options, all these types of things. Those are considered securities. And again, we're talking about safes and convertible notes today. So you got to make sure you're going to comply with it. Usually in this space, when we're talking about seed stage companies, we're talking about smaller raises, ideally from accredited investors. Those are investors that there's a definition in 501A of Reg D, which says who they are. And most of the time, especially if we're talking about individuals, we're talking about individuals who make $200,000 a year or more for the last 2 years, or if they file jointly, 300,000. Or they've got $1 million in assets subject to some measurement requirements with regard to their primary residence. That's usually who we're talking about. And you want to have a pre-existing substantial relationship with them, or someone at the company who's in an officer position needs to have that kind of relationship so that you don't inadvertently conduct what would be called a public offering, which would require you to register with the SEC, basically kind of go public right from the get-go. And we could talk a little bit more about why that's important, but keep in mind primarily this: if you don't comply with this, there are two things kind of that can happen. One, you may end up in a situation where you need to remediate, that is, fix the problem. And to do that, that means you have to give the money back and give the investors the option to get their money back. And if you need that money or you've already spent that money, that's just not going to fly. Or two, it can gum up a next round of financing. So that's kind of the takeaway there. I'm going to pause here. It looks like we've got some questions that have rolled in. As I mentioned before, if you've got questions, please use the Q&A function. It's easier for me to track as opposed to the chat. So let's take it out. Okay, there are 4 types of safes on Y Combinator, and we need a review of these in terms of pros and cons before them, and one of them that has the most flexibility for the startup. Okay, we'll talk about that question a little bit later. Somebody says they're a startup. That's fantastic. Seshu, that is. And then Seshu also has a question: what's the minimum authorized capital recommended for a startup, which will also issue safes? So I presume Seshu is asking about the minimum authorized capital stock, as opposed to the capitalization requirements, which is relates to the amount of money that needs to get put into the company. But usually we either set a company up with 10. I kind of favor the 10 million shares of common stock because 10 is like an easy denominator to figure out percentages. But other folks use 20 million shares of common stock. What do you think about Nevada C Corps? They seem to be much more cost effective for entrepreneurs. In this space, we really see Delaware C Corps all the time. And if you've got something else other than that, the investors will quite frequently make you convert, if that's a mechanism that's legal for what you have and where you've got it, or do a merger if you can't get the conversion mechanism. And the conversion mechanism just basically allows you to automatically change the one company into another versus having to merge, which is basically dissolving the one company into the other. Do you need seed to do a prototype? I thought seed is used to start the company. Well, look, there's a little bit of squishiness kind of in here. If you are able to build a prototype without raising seed funding, or you are able to start a company without seed funding, that's fine. I mean, if you're able to bootstrap, okay, that's frequently called the alternative is bootstrapping. That is, you're able to self-finance and then get profitable quickly and then kind of plow that capital back in until you're going to do a Series A raise or something along those lines. That's totally legitimate. But I'm giving you sort of the general definition of a seed financing. That's going to be for building out prototypes or tweaking or, coming up with your, sort of minimum viable product and be able to get that to market. and the team to do that, the initial basic team to do that, as opposed to kind of when you get to the Series A, the investors are going to look to see that you've already got a demonstrated traction in the marketplace. So hopefully that answers that. But my goodness, I did not realize quite how many questions we have. Okay, we're going to get into the next one. Real quick on a related note, can you walk through milestones of seed, Series A through E, and how each tranche makes sense and when and why? Okay, we already started this. Sort of seed, get your initial team together, get your initial prototype together. That's the sort of seed tranche. Depending upon what space or sector you're in, and it depends, right? Like if you've got sort of a pharmaceutical startup, you're not going to be able to have any revenue until you have gotten FDA approval on it. But kind of outside of that, in many other spaces, you got to have your product on the market. Consumers have to be buying it, and then it's about getting an injection of capital to grow and scale, and to demonstrate success, and then sort of the B's and C's and later are just about your growth strategy. So, if you're going to keep being able to gobble up more market share, that could be a strategy, or maybe you've got some other products that you want to launch, and then you raise the B and the C to do that later. The sort of one thing to keep in mind for entrepreneurs is that everyone's kind of focused on dilution when it comes to and board seats and other things as it comes to control rights that VCs have. But really, one of the most common or one of the most powerful rights that they have is the fact that they are allotting a certain amount of capital based on your current business plan for some milestones effectively. And so as a result of that, you got to hit those targets if you want them to put in more money. And then, of course, and I say that in the sense that, like, look, most funds have funds are set up so that they'll make an initial investment, and that's a way to sort of test you out and see how you're doing. So they've got more capital to allocate to your company if you do a good job. That's how funds are set up. So that's how the mechanics work. So that's what they do. It's another mechanism, not in a bad way, but it's another mechanism to gain some control, to make sure that they're investing their investors' money wisely. Okay, we have just so many questions that I'm going to just keep moving through. If you've got a question, use the Q&A and we'll try and get to it at the end. And I'll try and move a little bit more quickly. Okay, so financing options. Let's talk about this, because you were focused on the series seed stage today. And that's primarily, especially in the Bay Area, Silicon Valley, we're talking about doing convertible notes or convertible equity. Convertible equity is better known as a safe, simple agreement for future equity. It's basically a prepayment to get preferred stock when the preferred round happens at a discount. Now, convertible notes are also known as bridge notes. And I like to say sort of that convertible debt is the parent of convertible, this is the parent of safe. And I say that because by and large, again, each of these instruments is really designed to have a prepayment, if you will, for the shares of preferred that are going to get issued in the future. And that prepayment is going to get a kicker, a discount, or a cap. And we'll talk about caps a little bit later. Now, convertible debt is the parent in part because it's got those features, except it's got an interest rate, which you'd have with kind of any debt or loan, and you got to repay the money over time. And safes are different than that. I mean, sort of at its core, a safe is just like a convertible note, except for the fact there's no interest rate and no maturity date. So there's no set time you got to pay the money back, and there's no interest rate. Now, sometimes if you're raising, and let's talk about dollars real quick. So at least out here, and it depends, it's really market dependent. So, we work in the Midwest, do work on the East Coast, or do work in, let's say, Europe or Asia or Australia. The sort of numbers are different, but at least out here in the Bay Area, if you're raising kind of 2 million, 3 million or under, you're probably in this convertible debt, convertible, or the safe space. As you kind of cross the $2 to $3 million mark and start going up from there, it's likely you may end up doing what we call a Series Seed price round, which Series Seed these days doesn't really have a standard definition, but most of the time it's kind of like a slimmed down or a leaner, meaner A round, if you will. And talking about venture rounds is an entirely different presentation. It's one of my favorite presentations to do. So we're not going to get into that today. Man, I might have already given away some of this slide. I was so excited about it. So convertible securities. So if we think about it, convertible securities is kind of like the main group. And then underneath there, you've got convertible debt and you've got safes. And what they do is they convert to future equity securities, that is usually preferred stock, at a negotiated discount to a future qualified equity financing. Okay, the reason why this happens and why this mechanism exists is that at very early stage companies, let me back up. When you're doing this, what you're doing is you're selling a piece of the company for cash. That's simple. And so you don't know what size or what the piece of the company is until you figure out how much the company is worth. So that's the really tricky thing, is figuring out what to value the company at. And so both the safe and the convertible note push or kick that can down the road. It's hard. It kicks that can down the road because neither of those requires you to value it by their terms. And again, the reason why they're hard to value is, like, who knows what a founding team is sort of worth and what their idea is. I mean, it's all about the idea. It's all about the execution. It's all about the people. And that's just too hard to quantify. So there's risk associated with that. If you put a price on the company at that point, you run the risk as the entrepreneur that you have sold way too much of your company. If you put a price on the company and you're an investor, you run the risk that you have, you've not bought enough of the company. You've paid too much for it, basically. Now, one of the other real benefits is that it's usually far less expensive to do one of these convertible securities than doing a Series Seed or Series A round. There are just fewer moving parts, fewer documents that need to get negotiated. And, to a large extent, it's been somewhat commoditized. And in a large sense, that's a good thing. It allows the founders to focus on building the company and not necessarily negotiating these agreements with their lawyer. Now, so let's talk about what the sort of main terms that are in convertible securities. So I've listed a few, and the ones that have asterisks next to them are in the convertible notes, but they're not in the safes. We talked about this already. The maturity date, that is the date you got to pay the money back. The convertible note is that it's a debt instrument. And so in fact, actually, you got to pay the money back at a certain point in time. And we'll talk about that in a second. The interest rate, that is again associated with convertible notes. And it is interest just like you've got on your credit card or your home, your mortgage, or your car loan, or anytime you do debt. Because you borrow the money, there's time value associated with it. Conversion terms, and we're going to talk about those in a moment too. But those are the mechanisms that take, that $100,000 convertible note or safe and then turn it into $120,000 worth of securities. And again, we'll talk about that, and we'll talk about that bump. One of the other really important terms, and this was sort of an imperfection, if you will, in the pre-September 2018 safes, because they changed forms around that time, is the amendment feature. And the amendment feature is basically, whose approval do you need to get in order to change the terms of the safe or the convertible note? And this is really actually important. For non-lawyers, it's probably washed right over your head unless you listen and you follow what I'm about to say. But sometimes, or at least in the original safes, you had to go out and get each safe holder's consent if you wanted to change any of the terms. Now you may say, oh, well, that sounds perfectly fair. Why wouldn't I have to get somebody's consent if they've given me money? And the sort of response to that is, look, corporations are kind of like republics, if you will. You got to build some constituencies. There are people who are acting on other folks' behalf. And you may come to a point in time where, let's say you've got a convertible note and that debt is coming due and you need to extend the maturity date. You need to have a mechanism to get everybody on board. You may not be able to get everybody on board. Someone could be on vacation, or they may decide they're not going on board. They're just not going to sign. Like, they have, who knows what they were thinking, but they weren't going to do that. So you need to have a mechanism so you don't end up basically forcing, among other things that could happen, forcing the company into bankruptcy because you can't get somebody's signature. Similarly, I don't know, maybe the deal you struck on those convertible notes or safes seemed appropriate or fair at the time, but in hindsight, it swung wildly against the company or the founder's interests, so much so that the new money, that is the venture investors, will not put money into the company unless and until the terms of the terms of those notes or safes change. So effectively, if you can't get that new money in the door, the company dies. That'd be no bueno. So what needs to happen is, again, you need to have this mechanism to get that changed and fixed. Now, these documents also have a bunch of remaining terms that are not common to negotiate. And I'm actually going to just put a little pin in an issue that we'll talk about a little bit later if we've got time. And that is, again, things are somewhat commoditized. The most commoditized thing is sort of the safes, because they're pretty standardized because they're put out by Y Combinator. In the convertible note world, there are all different kinds of convertible notes. There is like no standard whatsoever. And they can vary widely with what's in there, and also exactly how expensive it is to do those rounds. So usually they're not that expensive. Everybody's keeping them lean and mean, but every once in a while you'll get some convertible, you'll get, if you're on the company side, you'll get an investor that comes in and wants to put a whole bunch of wild terms in your convertible notes. And you got to keep an eye on that. There's no standard with regard to convertible notes. Now, so we talked a moment ago about terms that had asterisks in there. Let's talk about them. So we're talking about convertible notes. The maturity date is generally 18 to 24 months. Being an entrepreneur, being a founder, being an executive at one of these companies, it's all about planning, right? And then executing on that plan. So when you're trying to figure out, am I going to ask for a 6, 12, or 18-month maturity, or 24 months, or some portion longer than that? Make sure you've got some cushion between that, So not theoretically, in reality, this money is supposed to be about enabling you to execute on your business plan. So it's going to take you some time to execute on your business plan. So you want to make sure you've got enough money so you can execute on your plan. You got some, to get some milestone, maybe it's finishing that prototype or whatever it is. You got some extra runway in there because, damn it always takes more time than you'd like to get something done. And then, enough time then to get additional money and to do an additional raise on the back end. So think about that cushion. Sort of rules of thumb that I think about. I would always say, starting from scratch, if you're going to go out and try and raise a Series A and you haven't been grooming investors or anything else, you should be looking at least 6 months. I don't think the pandemic, there are many things that are horrible in the pandemic. Also a bad outcome for startups, especially early stage startups, is I do think it's taking longer to raise early stage capital. Now, look, there are some other pitfalls regarding securities laws and other things you got to pay attention to. Out here in California, we've got the California financing law. Again, you just want to make sure that if you're an investor, this is particularly important because this is something that can bite you. You want to make sure you got an exemption that applies. Let's talk about interest rate. And then I'm going to pause and just kind of zoom through some questions and see if there's anything we can knock out quickly that's on this point. And if not, we might just have to hold it to the end. So interest rate for convertible notes, this can be as low as the applied federal rate that's set by the federal government. Right now, it's close to 0. One of the issues is if you don't have an interest rate in there, or in fact, actually, if the interest doesn't have to be paid until the end of the note, you can end up with either the company or the investor owing a bunch of taxes. So that's something to pay attention to. The interest rate, at least in California, can be as high as like 10% out here. Again, there are some exemptions and exceptions for that, but we sort of usually see it in a band around 4 to 6 to 8, probably closer to 6 to 8 if you're going to be doing a convertible note. One thing that we haven't talked about and that you haven't seen, and that does pop up from time to time, especially outside of the Bay Area, is that investors will ask for a personal guarantee from a founder. A personal guarantee means if the company doesn't pay the money back, the founder is going to pay it back himself or herself. If you're in a startup that is intended to raise venture capital to grow and scale, especially from the Bay Area, we don't do personal guarantees. This is about trying to get an idea, off the ground. It's not the same as if, you had a business that you've been running for the last 10 or 15 years and you just needed some leverage or some debt in order to hire a bunch of other employees to take advantage of a business opportunity. So I'm going to keep moving on. Before we get into the conversion terms, I'm going to just see if there's any questions that are kind of related to what we just talked about that I could knock out quickly. And I'm going to take a drink of water. Does the investor decide the SAFE or convertible note, or does the startup? Great question. This is something that we or your startup attorney will work through with you. I think the best practice is think about what the appropriate round is going to be for the company, and then go out and try and see if the market will bear it. That is, can you get that out of the investors? So, I'm definitely sort of a grab the bull by the horns kind of guy, especially for the early stage stuff. If you're raising from angels, or maybe even micro VCs. In terms of setting it, it's by mutual agreement. Can you kind of get ahead of it and maybe end up with the results you want if you're appropriately assertive? I think that's true. And that's why usually, we say, my typical guidance is if you can do a SAFE, then you don't have to worry about the interest rate. This is when I'm company side. If you can do a SAFE, you don't have to worry about the interest rate. You don't have to worry about the maturity date. You don't have to worry about the debt liquidation preference, which we may talk about a little bit later. So that is that's my typical guidance on that. Okay, I think I answered the difference between a note and SAFEs, which is more widely used. Difference between note and SAFEs are basically, at their heart, they're basically the same thing. Except for the very important components of the notes, which include the interest rate and the maturity date. I say like they're basically the same with this little difference. No, it's actually a really big difference. But at its heart, it's really about sort of prepaying to get the future equity at a discount. And which is more widely used? I think if you did it on a deal by deal basis, it's probably convertible notes, because I think they're just more widely used all over. But SAFEs are super common out here in the Bay Area. These are great questions. To register as a Delaware C Corp, do we need to relocate in the United States? No, you do not. That's a whole different presentation in terms of relocating to the US and how is it that you do that. I actually probably have a recording of that if you want to take a look at it, and we'll probably do that one again anyway. But you don't need to relocate to have a Delaware C Corp. Okay, I think I knocked out the ones that are going to be answered easily, and then we'll save the rest for last, for the end. Okay, conversion terms. Like this is the crux of it. I keep talking about how you're basically prepaying. And then you get a discount or a cap or a kicker. So at its heart, it's about having that SAFE or that convertible note change or convert into shares of preferred stock at the preferred financing. So there's a mechanic. and basically we say like the mechanic is the safe or preferred stock will convert at a discount, and then, the discount might be 20, 25%, at the preferred finance, at a qualified financing. And that's it gets defined a little bit differently everywhere, but typically we see sort of an equity financing. Okay. So we're not talking about another convertible. We're not talking about a convertible debt round. We may see something in the definition like a sale of preferred stock. Okay. So that you don't inadvertently trigger it by doing a bunch more safes. And there's a round size, typically for early stage companies, that's like $2 million. The goal there is really so that the investors, that is your safe and convertible note investors, feel comfortable that this isn't really just your uncle putting in $10, but saying the company is worth $100 million, right? Your uncle, you and your uncle aren't going to collude to value the company at $100 million and he makes $100 investment. Okay, because the effect of that is that you might basically limit the number of shares that those investors would otherwise be entitled to. So in terms of the terms, when we're talking about discounts, we're usually seeing 20 to 25% or so. The issue is if you start going up past that, that's one of the things that the next round of investors might not like to see. They might think the founders are getting too diluted at the conversion time. Same thing if the cap is like too low, and we'll talk about that in a second, which is when those amendment provisions might get triggered. Sorry, I'm going to. We're not. Okay, let's talk about conversion price caps. A conversion price cap is kind of a tricky thing to talk about because there's a lot of chatter on the internet saying like a price cap is really a valuation of the company. And that's not true on a host of levels. I mean, it's not true because you don't know what the company's going to be valued at until the Series C or Series A is done, until that preferred round is done. It doesn't set the price of the common, or you don't have to worry about it setting the price of the common like you would if you did do a preferred round. And by saying the price of the common, I'm talking about if you're going to issue shares to employees and consultants, what is it that they'll have to pay if they're buying restricted stock, or, what is the exercise price of their options going to have to be if you're issuing them options. So it's not really valuation. Now, from the company's perspective, when we're talking about a cap, I like to think of it on sort of company favorable side, like, the money that we're getting right now is going to be used to build stuff and make the company a lot more valuable, right? So if the company this money that we use turns out to make the company even more valuable than we had anticipated, and what we anticipate is what we're going to set at the cap, then by the mechanics of the math involved, our safe holders, in this case, let's call them safe holders, are going to get a bonus. Instead of getting like the 20% discount that we were talking about, that we had put in there, if we were talking about having both a discount and a cap in that instrument, they're going to get effectively sort of a 50% discount. And we're going to do a bunch of the mechanics and the math on this on the back end. So I'm going to keep cruising. But on the company side, try and get away from the idea of valuing the company today. We think about it really as being a way to be a kicker in the future if the company becomes more valuable because of the money that you're raising today. That is, you're really able to squeeze a lot of value out of those dollars. Some of the other conversion or mechanisms that we see in terms of conversion, is if the company gets sold. Okay, that's another time when the safe or the convertible note would maybe turn into common stock in this case, but as a way to, basically get cashed out. And sometimes we see that sometimes you build in there a mechanic to deal with this issue of maturity, which maybe the company will convert the safe into common stock if you hit the maturity date. That's a little bit less common out here. In terms of the documentation, the convertible notes, usually one or two documents. in addition to getting the board consents and or maybe any side letters that investors negotiate. In safes, there's usually one agreement and then just the safe. And then sometimes there's some side letters or corporate authorization. Common pitfalls, non-compliance with the securities laws, standard terms, using finders. Those are unregistered broker-dealers to find you money, can be a real problem and can end up in a situation where you're going to have to remediate. Side letters. I'm going to hit on this real quick. I just did. So those are like deal terms that the investors want that are outside of the safe or the convertible note. They might be observer rights or a board seat right or information rights or pro rata rights. That is the right to buy stock in the future. And those just, they can just make the cash register go ka-ching, ka-ching, ka-ching as you're trying to put these instruments together and make them lean and mean. And another pitfall is not obtaining proper corporate authorization. So I want to just keep cruising along a little bit to make up a little bit of time because I really want to talk about dilution and we're going to walk through some math so you can actually see how caps work and you can see how discounts work. So let's just kind of basically do a recap. Convertible securities, the upsides, at this point, at this stage, in the seed stage, it's the most common way that this is done. They're generally cheaper. They're sort of simpler to do. No valuation of the company because it's nearly impossible. You don't really know how valuable was Facebook or whatever, just when it was like, first days in the dorm room. Nobody knew, right? Nobody knew. And avoiding the valuation also helps. There's a typo in there. Justify a low fair market valuation for the stock options and restricted stock. So if you're issuing stock options to employees or consultants, or you're selling them restricted stock at a very low price. Downsides, especially for convertible notes, look, it's debt. It may, it's got interest. It may be required to be paid back at some point. And if you can't pay it back and your investors won't extend the maturity date or otherwise agree to convert it over, it could force your company into bankruptcy. And then something else that I mentioned is that, when we think about the preference stack, that is who gets paid first, if the company gets liquidated, that is turned to cash. First it is, secured debt, then unsecured debt, then preferred equity, and then common equity. And so if you've got these convertible note holders, they actually may sit above, if you've actually done some sort of preferred round and you're doing a bridge round between like your Series A and your Series B, like they'll sit in front of the Series A holders. So, the liquidation preference can kind of trick up some things depending on the deal. So with that in mind, I want to keep humming along so that we've got plenty of time on the back end for questions. And I want to touch on a super important topic, which is valuation and dilution. And I'm going to give you sort of like a plug. We're working on doing another one of these sort of presentations or panels that's just dedicated to this. Probably going to happen maybe towards the end of March. And we're going to give you like a real nuts and bolts walkthrough on all this. But I'll keep it high level today, but should hopefully still give you enough of a sense so you know what's going on. So pre-money valuation is the value of the company before the next round of financing comes in. And post-money valuation is the value of the company after the round of investment. So it's basically post-money is equal to pre-money plus the new money. Now, there are some alternative ways, as with everything else in the law, there are some alternative ways to look at it. But I think that this is definitely the simplest and easiest, especially as we walk through like these mechanics. And we think about it really from the sense that as I do these Series C price rounds and Series A price rounds, the new money that's coming in at the time, that is those Series A or Series C investors, they really care about the percentage, they're putting in X dollars for Y percentage of the company at the end of the day, right? So they really do look at it like, what's the post money? What does that look like to us? What's our percentage after everything has come in? So let's start with a super simple example. We're not going to keep in mind like the option pool. We're not going to think about anybody else having any kind of equity or anything out there. We're going to keep the numbers nice and round. And don't use these numbers as your sort of starting points if you're trying to do this stuff at home. In terms of like if you're setting up your own company, these are just nice, round, easy numbers so that I don't get hung up on doing internet web math in my head, which would be a disaster. So in this case, we're going to talk about a hypothetical company that's got a pre-money valuation of $10 million. And let's say that they've got 10 million shares split up among all three founders equally. So founder A has got 3,333,333 shares, or roughly 33% of the company. B and C are in the exact same bucket. Now, the investors want to come in and they want to put $3 million into the company. So they got to figure out what are they going to pay for each share. So they say, well, look, you got a pre-money of $10 million and we'll divide it by all of the outstanding shares and everything that could be converted into outstanding shares, which would then be called the fully diluted basis. And you're going to get $1 a share. So they'll pay $1 a share, they'll get 3 million shares, and then the company pre-money valuation was 10 million bucks, and then the investment was $3 million, so the post-money is 13. Pretty easy. Now you can see how this dilution works. Initially, founder A had roughly 33% of the company. And look, there was like, let's say it was super early stage right at the beginning, and it was only worth a penny a share. Basically, their shares were kind of worth $0 or close to $0. Now with this new money, at the close of this round, everybody sort of feels good and they feel like, look, the company is really $13 million. So if A's got 3,333,000 shares, she's got roughly $3,333,333 in value in the company. And her percentage has gone from 33% to 25%. Now let's kind of do a little bit of math here when we're talking about, if we were talking about if there had been some convertible securities in here. So if there had been a $500,000, let's just say safe with a 25% discount, that holder would have gotten 666,000 shadow shares. Shadow shares are shares of preferred. They're basically the same as what the regular preferred with the new money is getting, except for a couple of things. There's an adjustment to the original issue price to reflect the fact that that those shares are being issued at a discount. Same thing with the dividends. The dividend right is also adjusted for that discount. So what does that mean? That means the reason why it works out that way is you've got, let me just move my notes because it's always sort of dangerous. You've got, so basically you divide then the $500,000 by 75 cents, right? Because it's 25% off of $1 a share at 75 cents. And that's how you end up with that convertible note holder getting 666,000 shares. But if there had been a $500,000 convertible note, or excuse me, a convertible safe with a $5 million cap, the holder would have received 1 million shares. That's because the value of their investment, again, was 500,000. And then again, the cap is going to be the cap value divided by the number of outstanding shares. So they're going to get shares at 50 cents a share. So you can see kind of how that mechanic changes and why it makes a big swing. Now, in a subsequent round, we're kind of going to go back to the original numbers, right? Where we're not going to do these safes or convertible notes, but just to keep it simple. But in a subsequent round, we're talking about maybe this B, the pre-money is 30 million. So what happened there, right? Initially it was $10 million was the pre-money, $3 million comes in, the post-money is 13. And then they, those founders, you're able to use that $3 million to hire a whole bunch of marketing people, really get out there and then generate a lot of revenue. And all of a sudden, well, people think this company is really worth $30 million. And now this investor, this new investor, and a mixture maybe of some of the current investors want to put in $10 million. So what's the price they pay per share? You take the $30 million pre-money valuation and divide it by the 13 million shares that are outstanding. Again, we're ignoring those safes that we were talking about before. So they pay $2.31 a share. The new investor gets roughly, 4.33 million shares. And the total outstanding shares, the denominator goes to 17 million. So founder's stake has gone from 33.33% to 25% to now 19.2. And you can see that, initially at the outset, the stake was worth close to zero. Then it was 3 million, 3.33 million at the close of the A round. But now it's worth close to 7.7 million, which is pretty good. That's the concept of dilution. That's how it works. We're almost out of time, but I think we're almost out of slides, which is good. So again, we talked about this before. One of the things you need to make sure you're paying attention to is the securities laws. There are a bunch of exemptions. I've listed some of them, hire counsel, work with your counsel. Again, these are the exemptions here in the US, and also one of them, the 25102F, is for California. You got to make sure you're complying with each country's securities laws as you're issuing securities over there, or before you issue securities over there, or even make an offer to issue securities over there. And then, at least in the US, the US law, which is overseen by the SEC, and then each state's law. I think that then takes us to the 8 o'clock hour, which is just in time for questions. So happy to jump back and go through anything that we discussed before. Let's jump into some of these questions. And bear with me one second here. Okay, there are 4 types of safes on Y Combinator, and we need to review in these in terms of pros and cons between them. And one of them has the most flexibility for startup to increase their authorized capital without getting constrained by the safes. So I'm going to try and hit this, but I usually have office hours weekly on Fridays. This Friday, actually, I'm moving, so I'm not going to be able to do it this Friday, but this might be something we want to talk about. I think what Seshu is talking about is, Y Combinator's got safes with a discount, safes with discount, no cap, cap, no discount, cap, discount, and then most favored nation. Again, if you, depending upon what's going on, the discount can be favorable or nice. If it seems like you're going to be able to take the money, so I'm talking company side, right? If it seems like you're going to be able to use those investor dollars extremely well and just blow up the value of the company, then the discount's probably, going to be the way to go for you if you can get a reasonable discount only. The cap would be punishing, right? Because we just saw the example where, if a company had a 25% discount and $500,000 in on that safe, the investor would get, what did we say, 666,000 shares. But if there was a $5 million cap, they would have ended up with $1 million. You'll get blown out of the water by the cap. That being said, it's kind of whatever you can get your investors to agree to. Seeing safes with both a cap and a discount is very common. Obviously, each of those terms is negotiable. Higher the cap, the better. In terms of the most favored nation, the MFN, that just basically says if you issue a safe that's better to somebody else, then we get those economic terms. So I usually kind of have companies stay away from them just because I feel like it can be kind of tedious to handle, but it's certainly very viable too. At seed stage and Series A, what is a better option for raising funds? My general rule is, if you're raising, the longer you can rely on a safe, so long as you have built accurate pro forma cap tables and you are either not having caps or having appropriately set caps, and those caps may change over time if you may do a couple of raises over time, then I say stick with the first pick is safe, second pick is convertible notes. Delay that valuation as late as possible if you can. That being said, if you're raising $5, $10, $15 million, the investors want to make sure they've got sufficient insight into the company. the ability to also influence the company's decisions, hopefully for the better. And they'll also feel more invested in the company, if they've got, well, this is their position, if they've got a board seat and they're, able to bring in strategic partners to help. So again, sort of usually staying safe, second tier convertible note is kind of the way to go, if you can get up to raising $5-10 million or so. But again, kind of you get up to past the $5 million mark, it gets pretty hard, but not impossible. Should I invest my own money to build a prototype or write a business plan and pitch it to investors? I think that in large part depends on, who you are, what kind of prototype you can build, what your business plan is going to be like, and who who be potential investors. So I don't think there's necessarily a set answer there. I mean, I always go to him. If you were Mark Zuckerberg, I wouldn't tell you to start spending your time to build a prototype. I'd say, you might not even need to write a business plan. You might just be able to write some bullet points. I'm talking about Mark Zuckerberg today, not talking about him back in the day. Just write some bullet points and pitch it to an investor, right? Get some money. And although he probably has enough money to do it on his own. But, if you are not a well-known entity, you may need to have that prototype to get people to have confidence that you're going to be able to actually put something together and execute, at least on the technical side of things. So hopefully that gives you a flavor for it. It's a tough question to just give you a concrete answer on. What kind of company should I found if my startup originates in Germany, Europe? Is there a kind of US ex-state C Corp applicable, and what are the differences? So again, like doing cross-border work is something that we do a lot of. We work with local counsel when we do that. There are a few things that we run through when we think about it. What's the parent company going to be? Where's the IP going to vest? What are the intercompany agreements going to look like? How's the IP going to flow between the companies? How is the sort of service or development work going to be done? How are the stream of cash going to flow back and forth? Again, usually we'll end up seeing a Delaware C Corp setup, but in terms of those other really important mechanics, that is way beyond the scope of today's conversation. But I would be happy to have a conversation with you. Again, I keep office hours. So send me an email, jgordon@pulsanelli.com. Again, not to give you specific legal advice, but just to sort of understand what the issue is and see if I can give you some general insider information on it. What is a good stage of revenue to be thinking for a seed round? So, I mean, seed rounds can be pre-revenue, absolutely. And now, I think it's maybe getting hung up on the stage names. Well, understanding the stage names, I think, is important. Understanding that they're a little bit fuzzy and they kind of depend on what specific sector you're in. It's going to influence what's going to be normal or typical. The other thing to really bear in mind is it's not just about that name, but also like who the investors are that play in that round. So like super early seed stage might just be friends and family. Still make sure they're accredited investors, please. If you kind of already have some of the team together, maybe even start to have, some mock-ups or some prototypes or other things, you might be raising from angels. So those might be, ideally angels who are in the space or in a space adjacent. So they are able to see your vision and really understand like the value of this business proposition. As you start to get to a point where you've got revenue and you're able to sort of de-risk the company from the, can I sell this product perspective, then, that's when you're talking about raising from sort of tried and true venture capitalists doing an A round. So look, having like real revenue that is growing over time is, it's going to excite investors. But I wouldn't think about it so much as a stage thing as, who's the investor, that player in that space, and then think ahead. build those venture relationships before you're ready to raise venture capital, so that you're, on their radar. Maybe they take a liking to you, maybe they can give you some guidance. Do be careful about, who your investors are and what information you're sharing, right? Because they may be investing in a competitor. But at the same time, I would think about thinking ahead and developing relationships at each stage you're at, and then thinking ahead so you start working that ahead of time. The organizers, do they have a meetup group? I'm sorry, Aaron, I don't know that. I don't understand that question. Are service-only companies, no product or IP, able to get seed? Interesting question. Look, everybody's got some IP, right? Even your brand is IP. So, you could be, what's a pretty common space that to sort of see this kind of thing, right? Consumer space, okay? Lots of times either sort of food and beverage or some fashion. I mean, that could very well be a company that is going to go down the venture capital path, raise seed capital sort of initially. You got IP, okay? You've got IP in terms of your branding. If you're doing service, like even that, right? Like I believe One Medical is venture backed. So I would, in one sense, consider them more of a service company, not knowing a whole lot about One Medical, other than the fact that I've gone there and they've been my doctor before. So yeah, it's all about like, what is the size of the market that you're addressing? How big should your company get kind of in terms of revenue? I mean, if you're talking about a company that's going to be doing $1 billion a year and you're going to need, 10, 20, $30 million to get there to scale, or 100 million, or maybe 200 million to get there, that's kind of looking like it's on the venture path. So I wouldn't discount service only and say there's no IP. So if we are at 10 to 20K monthly in the first 3 months of a launch, should we go directly to Series A? I mean, I would consider it. What I do is I pull some comps to see what's out there and see what the, kind of get a sense for what the market is, what the market will bear. Really what kind of sets your A versus doing a seed is how much money do you need to raise, and what's it going to do basically, like where's that on your path to scaling? And I mean, I've seen people raise, I've had clients raise, just off of a whiteboard. They do a Series C or Series A. So, it also just sort of depends on who you are and your relationships with investors. Can you raise money with a small team, minimum viable product, MVP, and one paying ARR customer? Again, build that business case, the venture model, venture path. Yes. Can we get slides? Yes, send me an email. I'll definitely follow up with the recording. Ollie, what terms do you have to consider your safe or convertible note in order to manage convertible debt in the case your business fails? Do you have to pay it back as a founding team lead? Okay, so we've got a question that kind of gets to the issue that I pointed out before, which is personal guarantees. Certainly here in the Bay Area and elsewhere in the venture market, if you will, the founders don't need to pay it back because they have paid attention to the terms of the note and they have not done a personal guarantee. When you get to the questions, can you name a few exemptions you're thinking for startups and fresh founders? Thank you. I think I had a slide on that. So, either Reg D 506 for federal, or 4A2 under federal, or 25102F in California for California. Again, those are common, hire a lawyer or, work on it at your own peril. It's up to you. I don't know whether or not they're correct for you. Are there any laws there either the entrepreneur or VC should be aware of? Hope that's not too vague. So everyone's got a lot of laws. Let's take it from like a US. Maybe the easiest thing to do is to go to the nvca.org site, download a copy of the stock purchase agreement for a preferred stock purchase agreement, which is what's very commonly used, or the template, the basic form from which we typically work to do a venture capital financing. And take a look in the reps and warranties section, which I believe is section 3, and you'll see about 25 to 28 of them that refer to a whole lot of issues. It refers to IP and employment and capitalization. That is, who's got an ownership stake in your company, and a whole bunch of financial stuff. And that will all kind of drill into what laws are, and privacy. It'll drill into all the things that you should kind of think about. Will you be covering Reg C? Probably Reg CF is what you're talking about, and EDGAR requirements. So Reg CF is the crowdfunding regulation. No, I mean, I do have it recorded. The last panel I was on, we started talking about the change in the crowdfunding regulations, which increased the amount that you can raise from $1 million to $5 million on a panel with 3 venture capitalists. And I started saying, well, it'll be sort of interesting to see whether or not anyone can take advantage of it. And overwhelmingly, the VCs were like, crowdfunding is really a different path. And I mean, I think that's true. I've seen crowdfunding companies then raise venture capital. So not impossible, but it's not very common. So I'm not going to cover that. What does this mean? What is discounted? So I think Robert's probably asking what is discount? Okay, so let's go back a couple of slides real quick. And hopefully maybe my numbered example worked it out. But what is discounted is the price per share of the security. So, the new investors are paying $1 per share, but there's a 25% discount for the convertible note holder, so that their safes are getting converted, their convertible notes are getting converted at 25% off of $1 or 75 cents a share. That's what we're talking about. We're talking about the discount to the price per share of preferred securities. Okay, I walked you through a conversion price cap example. Many times someone will make an introduction that results in an investment. How is that handled in relation to finders? Look, intros are fine. The issue with founders really come about if somebody is doing it for some sort of compensation, whether it's stock or cash or some sort of back scratching favor. That's what we're talking about with finders. If someone makes an introduction, if they're a service provider like a lawyer or accountant or your HR person, and they say, oh my gosh, I happen to know this investor that just loves this space and is looking for it. And they make an introduction and they don't get paid out of that. That's not a finder. That's not a problem. It's those folks who say, I can, the most concrete, easiest to spot example, and there's kind of a whole continuum in between, is, somebody who says, well, give me 6%, they're not a registered broker dealer. And they say, give me 6% and I'll find a bunch of money for you. And then they go out and then blast the internet to get you funding. That's a problem, at least here in the States. Under what circumstances does a safe need to be paid back? So that is one of the interesting things. There are no set circumstances. Well, okay. So what does paid back mean? I mean, if the company were to be sold, there would be a payout associated with that. But if we're just simply talking about your standard run-of-the-mill safe and the company is doing fine, it just hasn't raised a preferred round, there's no mechanism to force the safe to get paid back. Now, that said, you don't really want to have unhappy investors on your cap table. And many times what will happen is, you'll work together with not a consortium, but a coalition of those safe holders to reach an agreement to make everything convert over. And that's another reason why that amendment provision is important, because you can end up in these sort of side cases. What are the consequences of large pools of options or low outstanding shares versus share cap on dilution in rounds? Oh, from convertible notes. I'm not sure I'm tracking this question. I think it's about basically having an option pool that's too big before your next round. And, you know, there are a couple of things that can happen. You can actually right size that before you do the rounds. And then there might be a question as to whether or not that right sizing will be reflected in the convertible notes or the safes in their conversion terms. So you'd have to take a look at that on a case-by-case basis. Or, you know, or the other is that sort of on a fully diluted basis, the founders are getting, and the convertible note holders, depending upon how these safes and convertible notes are structured, they might be getting some extra dilution right now, but on the upside in the following round, you won't necessarily have to increase the option pool as much. So it might be a little bit of a wash. I mean, if we're just talking about just a fraction of a couple points, it might not be worth doing. You got to run the pro forma cap tables on this. You got to run them. Another plug for what we'll be doing in March. Can you go back to the previous slide for a second? I don't know what that slide was. Sorry. Where in Florida are you? We are located in Miami. I should move to Florida. I'm in the Bay Area. I'm in San Francisco. I do like Florida though. I'm an East Coast guy. That's where I grew up, although I like it out here. I met my wife out here. So if you're relocating to Miami and you want to invite me out, love to go out and have some beers with you post-COVID. Thanks. Are safes only applicable in the US or can they be applied anywhere in the world? Is there a standard around this? I will say, okay, so safes kind of came about circa 2013 or so. The first 2 or 3 years, maybe 2012. First couple of years, they really weren't that popular. Then they started getting popular out here in the Bay Area. And they were like still never done throughout the rest of the US. And then they started getting done more and more in 2017, 2018, the rest of the US. Safes are getting done outside of the US, but it's, you know, I would still say it is the exception, not the rule, at least in the deals that I come across. If the company can't secure any investment after the effort with the safe investment and has to pull the plug, what's the remaining equity divided usually? What's the founder's legal liability? So usually kind of the company by that point has like totally like run out of it. It just sort of depends on where you're at. So if the company's like completely run out of assets and there are no assets to be paid to anyone, well, then there's nothing else to get paid out. If there are some assets to get paid, you'd have to take a look at the safe because there's a little bit of depending upon which kind of safe, either the pre-September 2018 or post-September. Like I haven't had to do a lot of work, and we might even bring in a bankruptcy person to take a look at that. But it's going to depend on where they sit in the preference stack. And my sense is that, in my recollection, is that the safe holder probably sits above the common holders. So they probably do have a liquidation preference. So if there's no one else sitting above them, the safe holders are going to have the rights to those assets. Now, that being said, one reason why we'd want to bring in or potentially make sure we get counsel from a bankruptcy or counsel is that there are going to be other creditors out there, right? There's going to be maybe your landlord. There's going to maybe there's credit cards and other stuff. And those folks will actually sit probably higher than the safe holder would. So, and if you pay the safe holder when you really should have paid your landlord, there can be some personal liability associated with that for the folks who made those decisions. So that's legit, and there's no way I can answer that without, no way I could concretely answer that without kind of doing a conflicts check, getting engaged, and having the ability to run through that. The slide between common pitfalls and decision to decision. It was a lot of, okay, let's go back. No, common pitfalls and decisions, we're back to back. I'm a solo founder of a tech startup. Would I be able to find a chief technical officer? What if I could play both roles? Would that be acceptable? Should I get most of the shares? If so, yeah, look, there's a lot of talk that sort of says you should have a co-founder. In one sense, I don't think I'm really qualified to weigh in on that. I have clients who are single founders. I've got clients that have 2 founders, 3 founders, 4 founders, 5 founders. Yes, if you are a solo founder, you're going to end up with the bulk of the shares, at least initially. And it's totally, companies are able to raise capital and to grow successful businesses being sole founders. So, you don't have to do that. Okay, sweet. Awesome. I'm getting some good feedback. Looks like I am addressing folks' questions. So always glad to have that. Does the note have to convert to a preferred, or can it convert to a low yield gross royalty? So especially in the last few years, there's been a push, I think, into the venture space by financial players who were not traditionally in the venture space. And so I've definitely seen things that are convertible notes and convertible note like that tie up revenue of a company, if financing, if the maturity date comes due or just under various other mechanics. Those need to be, they may be the right fit for your company, but you really do need to carefully think through those, because if one investor is going to be siphoning off revenue, that's going to deter other investors from coming in. So, if it's sort of your last round of financing that you're ever going to need, might be a great fit. But if you think that you're going to need to raise additional rounds of venture capital, it's probably pretty likely that that's sort of something where they'll be siphoning off or paying a gross royalty is probably not a fit. Can you give some examples of exemptions? I think I have a slide on that. Oh, as an investor, what if a company can't pay back a note? Do you just let it go? So, many times, well, at the outset, it's always important to know that these are extremely high risk investments, and that, probably statistically, the most likely outcome is that you won't get your money back. Now, kind of with that, and founders should know that too, and should, even though you may have confidence in your idea, you want to make sure that you're raising from people who can afford, to make that investment, and to potentially lose that investment. Now, as the investor, I think there needs to be an assessment as to, is there really nothing that they can do? What we frequently do see is seeing an extension in time in terms of maturity date. But one of the real problems is, if there's just a startup that's raised, I don't know, 100 or 200K, and they've got $20,000 back in the bank, unless you can work something out, it's just financially not going to make sense to chase them down, to hire lawyers to do that. So that's a really tough situation. And I think, but by and large, hopefully those founders have been keeping you in the loop the whole way. Information, so founders keeping your investors up to date with what's going on with the company is super important, so there aren't surprises when it comes to these types of issues. What are the must-haves for pre-seed level funding? Is revenue a must? look, there are really no must-haves other than, I mean, there's a sort of spectrum. If you're an unknown founder and you don't have any network, but you're able to basically bootstrap something that is immensely profitable right off the get-go, you will likely have, and then just needs additional capital to scale and just become $1 billion company, you will likely be able to get, funding pretty easily once people start taking notice of you. If you have had a successful startup before and exited and made your investors some money, and you could probably, again, just raise off of a couple of bullet points. If you've not done a startup before, but you've got, rich or wealthy friends and family who can fund you, you don't need to have seed funding. So in that sense, there really kind of aren't any must-haves. You'll have to do an assessment of kind of what are your resources, right? Who are the people what is the space that you're in? Maybe you're coming out of academia and you've got some great research that you're going to be able to commercialize. And let's just say it's like in the life sciences space, right? There's not going to be any revenue off of that if you're doing some sort of medical device or test. I mean, that's going to be years away from revenue. So I hope that's a little bit helpful. Do I recommend crowdfunding or against it? I just honestly, it's not a for or against. It just, in the space that I'm in, we just usually don't see a lot of companies do crowdfunding and then pivot to venture. How do we come up with our pre-money valuation? Do we need to have an in-depth model, even though most VCs acknowledge these are not a reality? So look, there are people who specialize in valuations. I'm not one of them. I think one of the things that you should keep in mind is that it is immensely hard to value, said it over and over again, value these early stage companies. And as a result, to a certain extent, especially if you're like pre-revenue or you just got a limited amount of revenue, the pre-money valuation is, in one sense, whatever the percentage of the company you're willing to sell for the number of dollars that you're willing to sell it for, and vice versa, right? So to a certain extent, getting into models, they're just models, right? It hopefully will reflect what will happen, but models always are imperfect. And you get too much in the weeds in that, and you start to lose the sense that, hey, really, this is about getting the dollars necessary to take something and start to scale it. Is it possible to go for a Series A funding if the company does not have clients and cannot generate post-revenue seed? What kind of negative impact? I've already kind of answered this question before, saying we're basically out of time. Are investors more accepting of corporate form in states other than Delaware? Look, if you got a really hot company, you may be able to get them to invest in your company, even if it's like a California corporation. But really everybody's doing Delaware. So, that's sort of what we expect to see. Let's see. Oh, I got some positive feedback. Thank you. How do we determine the percentage of shares given to other founders? Is it only based on capital contribution, sweat equity? That's a great question. Let me give you the 30-second answer. I think what you need to do is the founders need to have a realistic assessment of each of what they're bringing to the table, and sort of create their own internal market to figure out, yeah, look, Jason's the one with the technical expertise. We only really see him, or he only sees himself sort of participating for the first couple of years, and then he wants to go off and do something else. Bob's got both of those things, plus has got the business acumen to do it, and sort of figure out what the percentages of them are. You do want to make sure that the shares vest over time. So if somebody leaves early, they don't walk away with all their shares. But this is a topic that's really kind of for another conversation. So I don't have time to get into it because we're already over. Actually, we started a minute or two late. So actually, I think we're probably about perfect. Anyway, with that, I think we're going to call it a wrap. Again, my name is Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney with Pulsanelli. I love working with entrepreneurs and investors as they deploy their capital. I want to thank Idea to IPO for having me today. Thank you for introducing me, Jennifer. I want to thank each of our attendees for coming. If you would like to contact me, feel free to send me an email at jgordon@pulsanelli.com. That's it's on the screen right now. And if you have registered, which you should if you're here, I will follow up with you with a recording. So with that in mind, thank you again for attending. Have a good evening or a good day wherever you are. Take care and be safe. Bye-bye.